Good afternoon. This is Sean Golding with Golding & Golding. As we are entering into tax season for those of you on extension, I thought we'd take a few minutes and go through the basics of when does a foreigner or resident have to file a U.S. tax return. We'll delve a little bit into U.S. person, type of income, things of that nature. So U.S. person, right? Well, step back, right? Citizenship-based taxation is how it works in the U.S., which means they tax you on your worldwide income if you're a citizen. But it's not just, to keep it confusing from the outset, it's not just for citizens. It's mainly three types of people. We're talking individuals now. U.S. citizens, born or naturalized, lawful permanent residents, or foreign nationals who meet the substantial presence test. You're hearing O1, B1, B2, B3, H1B, L1, anything like that, E2, E3, even if you're not on a visa, and you're here for a sufficient number of days so that you pass the substantial presence test, then you have to go ahead and file just as if you were a U.S. person. That typically involves worldwide income and worldwide reporting. So from an income standpoint, if you're earning income, let's say you're employed in the U.S. or you're employed overseas. In fact, you could live overseas and earn all of your money from overseas. You still have to file a U.S. tax return and report your worldwide income. Same goes for income from investments. So when you're a U.S. person, you might have interest, dividends, capital gains, royalties, bonus from your insurance or assurance policies. The baseline perspective is that it's all taxable. Especially in Asian countries, oftentimes passive income is not taxable. Unfortunately, that tax-exempt status doesn't normally carry over to the U.S. It's taxable. Now, there may be treaty elections. You may be able to elect to be treated as a foreign person, way beyond the scope of this initial summary. But essentially, whether you have earned income and whether you have foreign investments, doesn't matter. Now, you might have ways to bring that down, and we'll go over that in a minute. This is to compare to a non-resident who has U.S. investments. So maybe you're a foreign national, you live overseas, you invested in some U.S. income that's taxed. And not everything's taxable. Real estate under FERPTA normally is, and dividends are. Oftentimes interest and capital gains, subject to certain limitations, is not taxable. So when you're a non-U.S. person, a foreign resident, and you have U.S. sourced income, that's different. You'll file a 1040-NR. If it's FDAP, which is typically investment income, they withhold 30% unless a treaty election applies to bring that down. Otherwise, it's ECI, effectively connected income, taxed at the progressive tax rates, just as if you were a U.S. person. Common example is someone who has a rental property in the U.S. and elected to treat that FDAP as ECI. That's an election that should be made. One other important issue is if you're a U.S. person, you have to do all the global reporting as well. FBAR, Foreign Bank and Financial Account Reporting, FATCA, Foreign Account Tax Compliance Act, Form 3520 for gifts and trusts, 3520-A for trusts, 5471 for corporations. That's all reportable if you're a U.S. person. Some key issues to consider. If it's your first year or your last year, we should have a presentation, a few before this, I believe. Whereas if it's your first year, you might have a dual status return. If it's your final year, you may have a dual status returns, which means if you make the election or you file that way, then only a portion of your worldwide income would be taxed. Otherwise, it would just be your U.S. sourced income for the portion of a dual status year that you're considered a non-resident. There's something called the foreign earned income exclusion. If you're a U.S. person and you're living overseas, you may be able to exclude typically around 100, 500, and 10,000. It adjusts for inflation each year. And then some housing exclusion as well. If you've already paid taxes overseas, you may qualify for the foreign tax credit on any of your income. One confusion that I see a lot, you may be employed, you may qualify for the foreign earned income exclusion. You can also use the foreign tax credit on that income. You just can't use it on the same dollar so that you don't double dip the foreign earned income exclusion and the foreign tax credit. There's an equation that's done that removes a certain portion of the foreign tax credit so that you're not doubling up on the exclusion. If this is all foreign to you and you just learned about this and you haven't been doing it for prior years, there are various amnesty programs you can use to get into compliance. Don't worry about the fear mongering. Most of it's garbage. 99% of people will safely make it through one of the disclosure programs. If you knew and you were willful, or you just can't certify under penalty of perjury that you're non-willful, you would do the voluntary disclosure program, traditional VDP. That's for both offshore and domestic. They got rid of OVDP in September 2018, then kind of merged it into the traditional VDP. If you're non-Wolfie, you got a bunch more options available: streamlined procedures, reasonable cause, and delinquency procedures. We've got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate, and it's something that we handle here. We limit ourselves to offshore disclosure and expatriation, primarily of prior year non-compliance. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.